Economic reforms. Economic reforms are a composite set of changes made to remove the distortions and inhibitions exist in the economic system. India had to go through the phase of economic reforms in the wake of 1991 balance of economic reforms. Economic reforms are a composite set of changes made to remove the distortions and inhibitions exist in the economic system. India had to go through the phase of economic reforms in the wake of 1991 balance of payment crisis, which in the present time seen as the game changer for the growth of Indian economy. Need of economic reforms. During 3 decades after independence, our country by and large pursued inward-looking import substitution strategy. Various structural weakness such as distorted investment, overvalued exchange rate, lack of competition, less incentive to innovate etc. crippled the economy. As a result, India faced macroeconomic crisis in 1991, which was cumulative result of both internal and external factor. The oil shock triggered by Gulf War in 1990 strained the balance of payment, which were already made fragile by several years of large fiscal deficit and increasing external debt. The internal political instability quickly turned the BOP problem into a crisis of confidence about the prospect of the Indian economy. There was a flight of capital in the form of withdrawal of non-residential deposits from the banking system, and international financial institutions were reluctant to extend new loans. Foreign exchange reserves rock bottomed to $1.2 billion United States dollars in June 1991, barely sufficient for 2 weeks of imports, and there was an imminent threat of default of external payments. In November 1991, the government entered into an arrangement with IMF to provide $2.3 billion United States dollars over a 2-year period. The course of events were largely perceived as national embarrassment. It was against this backdrop that the economic reforms were introduced in the economy and can be aptly called as crisis-driven measures. Structure of economic reforms. One of the most radical changes implemented in the reform was in the area of industrial policy that removed several barriers prevalent in the earlier environment. The system of industrial licensing earlier required government permission for new investments as well as for substantial expansion of existing capacity, was abolished. The new industrial policy was announced in July 1991 that abolished the requirement of an industrial license from the government in all except 5 specified industries. Licensing is now needed only for a small set of industries, primarily because of environmental and pollution considerations. (16) General Studies, Mains, Paper I. The controls over investment and expansion by large industrial houses through the Monopolies and Restrictive Trade Practices (MRTP) Act were also eliminated. The restrictions that existed on the import of foreign technology were withdrawn. Today, only one industrial sector is reserved for exclusive development by public sector, viz. the railway transport. There are only 5 manufacturing industries that need industrial licenses as alcoholic beverages, electronic equipments, tobacco products, hazardous chemicals and explosives. Structural reforms were initiated in the form of liberalization, privatization and globalization. Liberalization, privatization and globalization, LPG. The economy of India had undergone significant policy shifts in the beginning of the 1990s. This new model of economic reforms is commonly known as the LPG, liberalization, privatization and globalization, or RAO. Manmohan Formula Model. The primary objective of this model was to make the economy of India of the world. These economic reforms had influenced the overall economic growth of the country in a significant manner. 1. Liberalization. Liberalization refers to the slackening of government regulations. The economic liberalization in India denotes the continuing financial reforms which began since July 24, 1991. Privatization. Privatization refers to the participation of private entities in businesses and services in vastest developing economy in the globe with capabilities that help and match up with the biggest economies. Transfer of ownership from the public sector, or government, to the private sector as well. Globalization. Globalization stands for the consolidation of the various economies of the world. Liberalization. Deregulation of industrial sector. End of small-scale industries near reserved. End of price fixation in marketplace. Financial sector reforms. Establishment of private sector banks Indian plus foreign. Freedom to set up now barks plus permission. To generate resources. Tax reforms. Continuous reduction in the taxes. Individual corporate tax. Restructuring. Privatization. Simplification and indirect taxes. Foreign exchange reforms. Rupees devalued equals increase of forex. Trade and investment policy reforms. End of quantitative restrictions of EXIM. Low tariff. Withdrawal of government from ownership and management. Outright sale of public sector companies. Disinvestment in PSUs. Granted special status to PSUs as Maharalna. Globalization. Outsourcing BPO. Clinical advice. Work. Trade organization. Facilitate international trade. Removal of tariffs. Removal of licensing procedure. LPG model. Rao Manmohan formula. Economic reforms. 17. Important sector of economic reform. The important sector of economic reform are as follows. Public sector reform. Reform of the public sector was very critical to the structural adjustment programs. However, these changes were implemented slowly. Instead of outright privatization, the government went for limited disinvestment of government equity in PSES, retaining 51% of the equity and also management control. The disinvestment helped provide non-inflationary resources for the government budget, without adding to the fiscal deficit. At the same time, the emergence of private shareholders in public sector units and trading of shares in the stock markets are expected to make PSE managements more sensitive to profitability. Public sector companies were told that their future investment plans must be financed either by internal resource generation or by resources raised from the capital markets. These strategies are bound to encourage and reward efficiency, productivity and hence profitability. The government initiated a process for determining whether a unit should be closed or not by amending the SIC Industrial Companies Act, SICA, to bring public sector companies under the purview of the Board for Industrial and Financial Reconstruction, BIFR, set up in January 1987, in the same way as private companies. SIC public sector companies, defined under the law as companies, which have completely eroded their net worth, are now automatically referred to the BIPR, which then will take all stakeholders on board to decide on a viable restructuring or closure. The main objective of SICA is to determine sickness and expedite the revival of potentially viable units or closure of unviable units. Role of public sector units after reform. The role of public sector reform are as follows. From welfare orientation, they would shift to function as a commercial venture with profits as an obligation. From production oriented, they would become productivity oriented. They will operate with greater professionalism, operational and functional autonomy. There would be consolidation and likelihood to mergers among public sector to achieve economies of scale. Their monopoly status would get diluted with entry of private and foreign players. The biggest challenge would be the ability to be competitive, productive, efficient and remain profitable in future. Financial sector reform. The financial sector reforms were unleashed to mobilize savings and allocate them to sectors for their most productive use. Several initiatives were taken covering both the banking system and the capital markets. The government announced a package of reforms to be implemented over a 3-year period based on the report of the Committee on the Financial System, Narasimhan Committee. The high reserve requirements applicable to banks in the form of the statutory liquidity ratio, SLR, and the cash reserve ratio, CRR, were essentially designed to support government borrowing at below market rates of interest and constituted a hidden tax on financial intermediation. The government announced progressive reduction in these high reserve requirements. The requirement for compulsory investments by banks in government securities was also progressively reduced. The interest rates on government securities are now becoming increasingly market determined. Earlier, the Reserve Bank of India prescribed a number of different interest rates on deposits of different maturities and also a large number of prescribed lending rates for different sectors and classes of borrowers. Deposit rates for different maturities have now been freed subject only to a single ceiling. On the lending side, the number of prescribed interest rates for different types of borrowers has been reduced. Prudential norms relating to income recognition, asset classification, provisioning and exposure norms, capital adequacy applicable to banks were brought in line with Basel Committee standards. General Studies, Mains, paper. This was done to improve the quality of lending, generate pressures for greater efficiency among borrowing units besides improving transparency and disclosure standards. The stronger and more autonomous nationalized banks with good balance sheets are expected to mobilize additional capital from the market by issuing new equity to the public. Banking sector reform. The banking system was also opened up to competition from new private banks and several new banking licenses were granted. This led to increased competition. These policy changes will couple with improved supervision by the Reserve Bank of India and strengthening of the management systems within the nationalized banks. The government also set up special debt recovery tribunal to help facilitate recovery by banks from defaulting borrowers. The end result of these initiatives would be a much more efficient banking system which would support greater efficiency. New private insurance companies have been introduced with limited foreign ownership. Subsequent to insurance nationalization in the 1950s and 1960s, all insurance was in the public sector, with just one life insurance company and 4 general insurance companies. The introduction of new competition has led to the introduction of new products and practices. A new regulator, the Insurance Regulation and Development Authority, IRDA, has been formed to govern the insurance industry. Capital market sector reform. Along with efforts to reform the banking system, the government also embarked on a major reform of the capital market. During the 1980s, the capital market grew remarkably in size, with an increase in the resources raised by the corporate sector in the form of corporate debt and new equity. However, there were not commensurate qualitative improvements in regulation, and stock markets suffered lack of transparency in trading practices. The result was that the investor protection was not ensured. Requirement of government permission for companies issuing capital was abolished by the repeal of the Capital Issue Control Act in May 1992. This also made the system of government control over the pricing of new issues of equity by private companies. Thing of the past, companies were free to issue capital and price new issues according to market conditions, subject only to guidelines aimed at effective disclosure of information necessary for investor protection. The Securities and Exchange Board of India, SEBI, was established as an independent statutory authority for regulating the stock exchanges and supervising the mutual funds. The focus was not on control and government intervention, but on establishing a framework of regulation to ensure transparency of trading practices, speedy settlement procedures, enforcement of prudential norms, and full disclosure for investor protection. Online trading and dematerialized trading were also introduced. An important initiative taken as part of the reforms was the opening up of the capital market for portfolio investments. Indian companies were allowed to access international capital markets by issuing equity abroad through the mechanism of global depository receipts. External sector reform. The measures taken in the area of external sector have been very successful. Merchandise exports increased from 6 to 13% of GDP between 1990-91 and 2005-06. Imports also increased from 10 to 24 of GDP over the same period. Foreign exchange reserves increased from 1.5 billion United States dollars to US $1657 billion. Exports responded well to the new trade policy and the exchange rate regime in exports. Liberalizing foreign direct investment, FDIs, was another important part of the economic reforms, driven by the belief that this would increase the total volume of investment in the economy, improve production technology, and increase access to world markets. These reforms have created a very different competitive environment for Indian industrial sector than existed in 1991, which has led to significant changes. Indian companies have upgraded their technology and expanded to more efficient scales of production. They have also restructured through mergers and acquisitions and refocused their activities to concentrate on areas to competence. Economic reforms. 19. Agriculture sector reforms. The reduction of protection to industry, and the accompanying depreciation in the exchange rate, has tilted relative prices in favor of agriculture and helped agricultural exports. The share of India's agricultural exports in world exports of the same commodities increased from 1.1% in 1990 to 1.9% in 1999, whereas it had declined in the 10 years before the reforms. But while agriculture sector has benefited from trade policy changes, it has suffered in other respects, most notably from the decline in public investment in areas critical for agricultural growth, such as irrigation and drainage, soil conservation and water management systems and rural road, etc. However, there is no doubt that investment in agriculture, related infrastructure is critical for achieving higher productivity, and this investment is only likely to come from the public sector. Indeed, the rising trend in private investment could easily be dampened if public investment in these critical areas is not increased. The main reasons why public investment in rural infrastructure has declined, resulting in deterioration, are the fiscal position of the state governments and the tendency for politically popular but inefficient and even iniquitous subsidies to crowd out more productive investment. Raja Chelia Committee on Taxation Reforms. In respect to direct taxes, the committee stressed the importance of lower, moderate rates of taxation. The system of taxation of firms has been rationalized by eliminating the distinction between registered and unregistered firms and a flat rate of tax of 35%. The surcharges were abolished. Tax incentives in the form of tax holidays for development of infrastructure were rationalized and enlarged. In the area of indirect taxes, rate reduction, rationalization and simplification of procedures were further carried forward. To encourage the growth of information technology and telecom sector, duty on these items were reduced to 15%. Important policies of economic reform. Stabilization policy of economic reform. The stabilization policy of economic reforms are as follows. The central government's fiscal deficit had expanded steadily during the 1980s and had reached a peak level of 8.4% of GDP in 1990-91. Black Circle initiatives such as the Fiscal Responsibility and Budget Management, FRBM, Amendment Act, 2018 enjoined the government to eliminate its revenue deficit and reduce its fiscal deficit to 3% of GDP by 2020. Black Circle similar acts have been passed by most state governments, making fiscal responsibility part of legislative commitments. The other achievement was the implementation of GST, which subsumed the plethora of central and states and direct taxes and made India a single market for goods and services. Exchange rate policy. Exchange rate policy went through a series of transitional regimes since 1991. The reforms began with the devaluation of rupee twice in July 1991. In the 1902-93 budget, the partial convertibility of rupee on the trade account was announced. The system was modified in March 1992 by the introduction of an explicit dual exchange rate system. Dual exchange rate policy. The raw material and capital goods were made freely importable against foreign exchange obtained from the market at a market-determined floating exchange rate. Imports of certain critical items such as petroleum, essential drugs, fertilizers and defense-related imports were paid for by foreign exchange made available at the fixed official rate, and the demand for foreign exchange at the official rate to pay for these imports was met by requiring exporters to surrender 40% of their export earnings at the official rate. General Studies, Mains, Paper 3. The remaining 60% of export earnings was available to finance all other imports, all other current transactions and debt service payments, at the market rate. The dual exchange rate system was a short-lived transitional arrangement to a unified floating rate which was announced in March 1993. The government in August 1994, as a logical step ahead, facilitated the full convertibility on current account. However, the capital account convertibility controls are still present. Outward-looking policy. In keeping with the objective of greater openness and outward orientation, foreign trade policy was substantially liberalized. The complex import control regime earlier applicable to imports of raw materials and capital goods was virtually dismantled. They can be freely imported except for a relatively small negative list. Change in foreign trade policy brought reduction in tariff rates and dismantled quantitative controls over imports. The removal of quantitative restrictions on imports was accompanied by a gradual lowering of custom duties. India's custom duties before the reforms were as high as 100%. The government lowered custom duties since 1991. The abolition of export subsidies to help the fiscal position was compensated by increase in export incentives in the form of EXIM scrips, special incentive licenses, to exporters which could be used to import items which were otherwise restricted. These licenses were freely tradable and commanded a premium in the market depending upon the excess demand for restricted imports. Besides, India has also undertaken commitments to liberalize its trade regime under WTO agreement. The agricultural tariffs remained high till 2007-08 at 19.3%, but fell drastically to 2.5% in 2009-10. The convergence of Indian economy to global inflation rates can be largely attributed to reduction in tariffs on non-agricultural products. Earlier, India's policy towards foreign investment was widely perceived by foreign investors as being unfriendly. The percentage of equity allowed was restricted to a maximum of 40%, except in certain high-technology areas. The foreign investment was generally discouraged in the consumer goods sector unless accompanied by strong export commitments. Effects of liberalization on economy. The years 1991-92 to 1993-94 were years of crisis management, when the primary objective of policy was to stabilize the economy. During the next years, the post-stabilization period, the focus of policy was on the longer-term objective of putting the economy on a higher growth path. Although the reforms completely succeeded in managing the short-term crisis and stabilizing the economy, the results in terms of the medium-term objectives of stimulating growth and investment were less promising initially. The reforms brought an improvement in the fiscal position of the central and state government and in creating a favorable macroeconomic environment which led to revival of investment in infrastructure. Positive outcome of economic reforms. India's GDP growth rate increased from just 1.1% in 1990-91 to 7.5% in 2015-16, making India among the fastest-growing major economy of the world. Foreign exchange reserve, which had reached year's lowest when economic reforms were initiated in 1990-91, now, June 2020, stood at more than $500 billion United States dollars. Foreign exchange reserve are crucial for macroeconomic stability of the country. Gross fiscal deficit, which shows about financial health of the government, came down from 7% of GDP in 1993-94 to 3.2% in 2018-19. India's per capita income swelled to 1.709 United States dollars by 2016, according to World Bank estimates. This was 5.6 times the 300 United States dollars per capita income India had in 1991. According to World Bank data, India's Domestic saving as a percentage of GDP stood at 24.3% in 1991, which moved up to as high as 38.3% in 2007 before seeing a sharp fall in recent years. The Economic Survey for 2017 noted the saving to GDP ratio stood at 29% in 2016. Economic reforms. 2121. The most impressive outcome has been on the front of inflation, which stood at 16.7% in August 1991. Now, Monetary Policy Committee of RBI has strict mandate to keep inflation at 42% in corporal. In social sphere, life expectancy has improved from 59 years to 67.5 years, while maternal mortality has fallen to 167 in 100,000 from 556 in 1990. Under 5-year mortality rate has also declined to 48 from 126 per 1,000 births. Negative outcome of economic reforms. The reforms were largely in the formal sector of the economy. The agricultural, urban informal sector and forest-dependent communities did not see any reforms. This led to uneven economic growth and unequal economic freedom among people. Market-based economic reforms also had led to increasing disparities between the rich and the poor and between infrastructurally backward and more developed states. Intact income inequality is one of the biggest problems in Indian society. Black circle due to decreased government intervention, the social sectors like health and education have been neglected. The private investment in this sector has not followed the socio-economic status of the country. Black circle economic reforms have accelerated growth but failed to generate adequate employment. In fact, the service sector, which had benefited mostly from these reforms, now contributes 60% to Indian GDP, but employed only 25% of workforce. In fact, jobless growth has been a significant outcome of these reforms. Economic reforms have opened the economy to foreign trade, which had led to surge of cheap imports from China and other countries. It has crippled the domestic manufacturing sector in general and medium and small-scale industries in particular. Generation of economic reforms. Though there was no such announcement or proposals while India launched its reforms in 1991, in the coming years many generations of reforms were announced by the governments. The total of 3 generations of reforms have been announced till date, while experts have gone to suggest 4th generations. Let's discuss about them in brief. First generation reform, 1991 to 2000. It comprised of various important liberalizing policy decisions, the dereservation and disinvestment of public sector. These reforms aimed at making public sector undertaking profitable, efficient, and separate. Ministry of Disinvestment was instituted for sale of majority and minority stake of government in PSUs. In external sector, policies aimed at abolishing qualitative restrictions on import, switching to the floating currency regime of exchange rate, full current convertibility, among others. The restrictive FARA Act was replaced with liberalized FEMA Act. Second generation reform, 2001. Basically, the reforms launched in the early 1990s were not taking place as desired, and need for another set of reforms were dealt by government, which were initiated with the title of the second generation of economic reforms. Under market reform, The many products in economy whose prices were fixed, regulated by the government under Administered Price Mechanism, APM, such as petroleum, sugar, fertilizer, drugs etc. were to brought into the market fold. For public sector, this generation of reforms emphasized on the areas like greater functional autonomy, freer leverage to the capital market, international tie-ups, disinvestment etc. In legal sector, many outdated and contradictory laws in Indian Penal Code, labor laws, company laws were abolished. For the first time, an important role to the state was designed in the process of economic reforms. All new steps of the reforms were now to be started by the state, with the central playing a supportive role. (22) General Studies, Mains, Paper 3. This reform also aimed at creating world-class infrastructure and encouraging and nurturing the spirit of entrepreneurship. Apart from greater tax devolution to states, the FRBM Act was passed by Center and the Fiscal Responsibility Act was followed by the states. It ushered a new commitment to fiscal prudence. Third Generation Reform, 2007. This generation of reform commits to the cause of a fully functional Panchayati Raj institutions, PRI, so that the benefits of the economic reforms, in general, can reach the grassroots level. Moreover, the constitutional arrangements for a decentralized development process was already effected in 1993. It was in early 2000 that government realized that full cooperation and well-functioning of PRI is critical for inclusive growth of the country. Arrangements for including PRI in execution of various central sector and sponsored schemes were carried out. Successive Finance Commission recommended greater devolution to PRI of the country. Fourth Generation Reform. This is not an official generation of the reform in India. Basically, in early 2002, some experts coined the generation of reforms which entail a fully information technology-enabled India. They hypothesized a two-way connection between the economic reforms and information technology, with each one reinforcing the other. In the nutshell, the different generations of the economic reforms in India should not be seen as completion of the former and commencement of the later generation of reforms. In fact, all of the generations are going on at present simultaneously, with the basic objective of reforming the Indian economy.